Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's June 12th. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. So a few weeks ago, I talked about my vacation, the Hard Rock Hotel in Dominican Republic. It was a good time. I mentioned how my 8-year-old daughter got sick the very last day. She was throwing up violently. She couldn't even take a sip of water without throwing up. So we needed to go to the hospital. She can get an IV right away. She was very pale, very dehydrated. Again, she couldn't even sip water. We were a little nervous. Now, we have a timeshare at the Hard Rock. And it's not specific to the Dominican Republic. We can stay at numerous Hard Rocks internationally. And I bought this membership about 5 years ago. We upgraded a few times so we could use it at even more hotels, get extra benefits like, more excursions and family rooms. And yeah, it was an amazing deal. If we go 4 times like we did already, it's awesome. It pays for itself. It's like the Disney annual pass. It's expensive. It's a little more than twice the single day price. But if you go more than 2 times, it pays itself. It's definitely worth it. If you can go 20, 30, 40 times, it's an amazing deal. That's kind of the deal we got. So, we're pretty good customers. Now, when my daughter was sick, we saw the hotel doctor. And the hotel doctor, she was awesome. And she said, look, she has food poisoning. Get a doctor at the Hard Rock. She said, we have to take her to the hospital. She definitely needs an IV. And, went to the hospital about 20 minutes away. And after blood tests, the doctors there confirmed that she had food poisoning. And she needed to stay at the hospital 24 hours. They gave her antibiotics. And it was great. And, thank God, we did that. Because it resulted, that whole entire process. And it happened the very last day. We had to change our flights, the scheduling. It's really crazy when you spend a week away and you're going to come home. It's just like a million things going on. And then all of a sudden, you can't come home that day. It's got to be another day. And it's just really, really hectic. So when we changed our flights and we needed to stay at the Hard Rock one more night, to my surprise, the hotel did not give us the room for free. And it wasn't like I was looking for anything free and say, hey, you know what, this is what you should do for us or whatever. For us, it was frustrating because the only reason why we're there an extra day is because my daughter ate your food at your hotel and got food poisoning. And they were like, no. And they actually said, you know what, we're only going to charge you $550, right? Which is daily rate since you're a good customer. I said, what are you talking about? How could you charge me? why don't you just do the right thing? I'm here because of you. And, when they told me that, I spoke to several people, including one of the top managers there. And I was really, really pissed off because when I spoke to the manager, not that she was giving me an attitude, but I was just surprised because she said, well, how do we know if your daughter actually got food poisoning at our hotel? I mean, she could have got it someplace else. And, at this particular place, guys, it's on 20 acres. They have a bunch of restaurants, and you can't walk anywhere. I mean, it'll take you 20 minutes just to walk out of it. That's how big the place is. So once you're in there, you're in there. I mean, you could drive someplace and go someplace else. And, they have tons of restaurants. So not to mention that they have cameras. You could see that we were in there if it really came to that. But the fact that she questioned me really bothered me. And now, if you fast forward to today, there's an article in the New York Post that's blowing this story wide open. And the headline for that story says, nearly 70 tourists to the Dominican Republic reported illness since March. And they have a picture of the Hard Rock Hotel and Casino. This is published yesterday. And they said nearly 70 tourists reported getting violently ill while vacationing in the Dominican Republic since March. That's up 10% from reported illnesses from last year, and more than 45 of them identified themselves as guests at the Hard Rock Hotel and Casino in Punta Cana, which is the hotel that we stayed at. So not only that, we're seeing a lot of reports that people have died. I mean, more than 6 people have died from illnesses, mysterious ailments, they're saying, while staying at luxury resorts, and a couple of these people were at Punta Cana. So somebody actually told a story and said, our family of 4 recently returned from a weekend vacation at the Hard Rock Hotel at Punta Cana, booked an all-inclusive package, and we all became violently ill after, they ate at one of the restaurants there, which we know the restaurant. And they said the family had to stay an extra night at the hotel, and it cost them $847. They charged them. And, they were too ill to travel, and, but they charge them for that money. Now, think about that for a minute, because now it's a national story. It's everywhere. I've seen it on CBS, ABC, and, I didn't really take it too seriously. I just thought maybe my daughter just, had food poisoning, but it could have been a lot worse than that. And thank God we took her to the hospital and we didn't take chances and say, hey, hopefully you'll be okay. And because now you're seeing the effects of this. But this is a major problem. I mean, and for me, I had a crazy rant on why people just don't do the right thing. And the right thing, give me the room for free. Okay, fine. Since it's your fault, I had to stay an extra day. Not to mention I had to pay close to $2,000 for my daughter to stay at the hospital overnight because of you. But now the story's out. These assholes, sorry for cursing there, but these assholes, and that manager I spoke to, they knew they had a problem. They already had dozens of people complain about being sick. Even had 2 people die at their resorts. And the manager told me, how are we supposed to know your daughter got sick by eating here when you know you have a problem? I mean, I'd rather you say nothing and just say, hey, we're going to charge you for the room. But for you to actually question me, and I'm a good customer, saying that, are you sure she ate here? How do we know? I mean, it's pretty easy. You could find out if you really wanted to through cameras or whatever. But I'm telling you, I'm a good customer. I'm being honest with you. I'm not asking for anything crazy. I'm just asking, just do the right thing here. We're totally inconvenienced. I mean, we didn't take a shower for 2 days because we took our daughter to the hospital back and forth. It was crazy. But that's what these guys actually did. They actually tried to convince me, or, hey, how did that happen? Not convince me, but when you have a problem at the hotel. I mean, how crazy is that? And I'm not saying it's just for a rant or a personal thing. I mean, my rant back then was, what happened to people doing the right thing? Especially when it comes to business. And I have so many business owners that listen to this podcast. I mean, people are going to get pissed off when you mess up as a business. And maybe you might have billed someone extra by accident. Maybe you had to recall a product for safety reasons, like we see with car companies and also healthcare companies. You know what? It's okay. Every business owner is going to make mistakes. It's 100% guaranteed that they're going to make mistakes. You're going to piss off people every now and then. But the way you handle your problems, being honest and transparent, doing the right thing, that builds long-term credibility with your customers. I have to tell you, there's people who've written in and said, Frank, and they just came in at the wrong time and they bought like 2 of my stocks that went down, and and they're like, I can't believe this. I lost money on this and that. And I looked and saw that they came in and said, hey, you know what? This is on me. You came in at a tough time. We're doing really well on a lot of other stocks, but these 2 went down, and they immediately came back. Said, Frank, no, listen, I made money from you before. This is okay. I was just ranting. I was just pissed off. But just acknowledging that and saying, hey, I knew when this guy came in during a period, like there was 2 stocks that didn't do well and this guy got wrecked. If he came in 2 months before, 3 months before, he'd be fine. If he came in after, he'd be fine. But just acknowledging and saying, hey, you know what? All right, I hear you. Built a customer for life, because I just answering him and say, hey, you know what? This is my fault. But just, doing the right thing. Like, there's so many businesses, especially today, that just don't do the right thing for their customers. Like, even in our industry, especially. Like, I've never seen an industry where so many people have lost money listening to the wrong people, and they continue to subscribe to these services, which is amazing to me. I mean, there's a theory in our business that says performance doesn't matter as long as you could tell a good story. Think about that for a minute. It doesn't matter if, a newsletter editor loses your money. As long as I'm entertaining you and talking about different trends and talking about how great this is, people are still going to sign up, which is crazy when you think about it. But at the end of the day, business owners doing the right thing, Dominican Republic didn't do the right thing. And not only that, I mean, look how dangerous the situation was. Instead of being, hey, take your daughter to the hospital, we'll take care of it or whatever, you tried to push it off like nothing's wrong. It's not our fault. When clearly, I mean, you're looking at 70 cases in a DR, and I'm telling you, after this story, my case isn't on there. My daughter's case isn't on there. There's probably hundreds of people that got sick that aren't on there. They're going to reach out now after reading this story. Now it's highlighted. Now you're seeing these stories of people dying in Dominican Republic. It's really crazy, considering tourism is huge in Dominican. If you take that away, most of those tourists come from the U.S., and now we're hearing this story. Listen, again, you had the chance to do the right thing. You didn't do the right thing, but it's probably a place we won't visit anymore, and we'll probably go to other resorts outside of that. But very, very, very frustrating. I just wanted to bring that up in case anyone's thinking of going there. It is a little dangerous. I'd be very, very careful. And the fact that they try to cover it up really, really bothers me. Because when I look at companies doing the right thing, I look at, when the president announced tax reforms, you had AT&T immediately gave a one-time bonus to every one of its 200,000 employees. Aflac American Airlines did the same thing. Altria paid 7,900 non-executive employees an extra $3,000 bonus. And we saw it with Binance, which is the largest exchange, crypto exchange. And it got hacked for $40 million. And this is crypto, right? People are skeptical. Immediately, they came out, they were transparent and said, hey, we're halting all withdrawals in case, they still stolen cryptos on our site. We're not going to let them come off our site. You had Coinbase come out and say, we're not accepting any transfers. Like the whole community got together. They covered the loss fully, made their customers whole again. And handling that just improves their credibility. It makes me want to go into the exchange knowing that, hey, I'm safe. If anything happens, these guys got my back. It's very, very important when you look at business that way, guys. And not that I wanted this to be a huge rant or crazy, but when you look at that situation, and it's talking about my daughter and safety issues where people have died, and she probably had the same exact thing, that a lot of these people were sick and probably just wanted to go through it. It's pretty crazy that they kind of look to cover that up, and it's very, very frustrating. So anyway, for me, you're highlighting this story in the New York Post and how it's going national now and global, where it's going to hurt their business specifically and that specific resort, but Dominican Republic as a whole. But by doing the right thing, you probably could have limited that damage instead of coming out with this. And it's such a surprise. It's 70 people now, which is probably 3 or 4 times. It's going to be 3 or 4 times that number who are sick and food poisoning. I mean, they had a chance to deal with this and do the right thing, and you didn't. You tried to cover it up, and now you're going to lose a ton of business going forward, because I can't see families going there after this story was released. Anyway, I want to move on here with the lesson of business is doing the right thing, because I have a great guest today. It's 40-year market vet Rich Suttmeier, who was on my podcast about 3 months ago. And we recently signed him to Curzio Research. We're providing a special column for us called Chart of the Week, just for now. We'll change that name, kind of generic. But it highlights ideas based on Rich's methodology for trading stocks. So there's a lot of technical analysis involved. You're going to see fundamental analysis. But more important on the technical side, he explains in detail about moving average, simple moving averages, how he's looking at this. And when you see it, you could actually use it for yourself. And thus far, since, just wrote 2 stories, one about Apple, one about Amazon, over the past 2 weeks, comes out every Friday. We requested feedback. 99.9% of the feedback has been amazing. Talk about hundreds of emails. And we're really happy. So I love when my customers are happy. I love when they're learning, and it's just really great. So I'm bringing Rich back to talk about his new partnership with us. And maybe if he takes on, or will he take on a bigger role, which could include writing a newsletter under the Curzio Research brand in the future. But he's also going to break down the markets like he always does, which we've seen rebound sharply over the past 2 weeks after falling for 4 straight weeks. So now, is it a chance to buy? Should we be buying here? It's going to go a lot higher, or should be taking profits? We're just going to break down favorite stocks and sectors and share one idea that he loves right now. And he's going to have a little bit of a bullish tone, which is kind of crazy for Rich. We always see some more, hey, I'm worried the market's going to crash. He's more bullish, but he's going to highlight a stock that not only is a great momentum play, but is trading at a dirt cheap valuation. Then in my educational segment, I'm going to share with you one of my favorite strategies that are going to help you buy some of the world's best brands at a significant discount. It's a strategy you can use for almost any company in the S&P 500. Talk about industry leaders, established companies generating huge cash flow, earnings, pays nice dividends. This is going to be a great educational segment. Please be sure to give it a listen. I promise it's going to be worth it. But first, let's get to my interview with the one and only Rich Suttmeier. Rich, so great to have you back on the podcast.
Thank you, Frank. Good to be here.
Well, let's start with the markets, all right? Let's look at the macro picture, because what we've seen over the past 9 years, at least, is buying the dips has been a great strategy. We've seen over pretty much the last 2 weeks, the markets have bounced back, but 4 weeks in a row, the market really got crushed, whether it's tariffs, whether it's Brexit, whether it's uncertainty in the markets. But now, the last 2 weeks, again, we're seeing the market try to come back a little bit. What are you telling your clients? What are you telling your people? Is another buying opportunity on the pullback, or should you be taking profits here? You're a little nervous.
Well, I think when you see the market go down as much as it has, and then a key level holding at the lows, you're essentially trying to pick a bottom for a trade. And now we're getting up to what I believe will be the upper end of the trading range. So you're looking at, all right, what did I buy during that losing streak? And let's take some money off the table. I think the prudent thing now is you're positioning with an allocation that's at a minimum to stocks because of the longer term volatility, and you have a 10% position in some sort of gold, and my favorite there is Newmont Gold Corp.
Well, you brought up a couple of good things there because you're talking about different levels, which I wanted to get into. Let's get into that, actually, because when we look at, I'm going to talk about how you're writing for us. I did a little bit of an intro, and I was going to go into more of the macro picture here. But since you mentioned it, let's give an education to the audience out there, because you're saying if a certain level holds, then you're looking to get in. Talk about that with the market. What level held? How do you find that level? Because I think that's important for people to understand technical analysis, because I always introduce you as, hey, this is my residential bull. I'm a residential bear, but that's long term. And short term, you're long a lot. You're buying stocks on these pullbacks. You're looking at levels. Explain that system.
Well, when I write about the 5 major equity ETFs, and one of them is the NASDAQ 100 shares, QQQ symbol. And my methodology has the last 9 weeks, months, quarters, semi-annual, and annual numbers chugging along in the proprietary analytics. And my annual level for all of 2019 is 169.27. Well, guess what the low was for QQQ? 169.27. And we bounced off of that, obviously, very quickly and very nicely. So that's a trade. You got out of the market because at the beginning of May, we had a inflation, what I call a parabolic, inflating parabolic bubble for the Dow, the S&P, and for QQQ. So we had the signal to get out in early May, and so you're looking, where do I get back in? And if it holds on weakness, you're getting back in. So you're trading the volatility, not betting on a new bull market, not betting on a bear market gathering momentum just yet. And that's what we're dealing with. And obviously the Federal Reserve was a wild card by changing their mind over and over again in the volatility.
You know what, Rich? Talk about the Fed, because that's something, I don't know if so many people know about you, but you've been analyzing the Fed's balance sheet for over 3 decades, probably over 4 decades. And when it comes to data reading market, you're the person I listen to the most. Talk about maybe, what you're seeing out of the Fed. I love, this is probably like 3 months ago when they kind of changed their tune. Maybe it was a little bit more like, in December, saying that, hey, you know what, we instead of, tightening or leaving alone, we're going to probably ease. And that really turned around the market in January. But you were saying, hey, this isn't like your typical easing because they're still deleveraging the balance sheet. Talk about the Fed, the impact. Is that priced in? And also, are lower rates that much of a catalyst? Is it factored in? Because we all know that they're probably going to lower them this year. It seems like it's factored into to the stocks. At least everyone's talking about it.
Well, I don't think you can cut the federal funds rate when you're tightening, using quantitative tightening. In other words, you're draining the balance sheet and you're going to cut rates at the same time. That makes no sense to me. And the quantitative tightening is $35 billion per month through this September, and then it ends they're no longer draining the balance sheet starting in October. So there's still a lot of money being drained from the banking system. So you have that as a pressure on the banking system and on the bank stocks. Yet, banks don't make money in a low interest rate environment. It kind of screws up their net interest margins. And they still haven't really gotten out of the hole from all those many years of low interest rates, because their balance sheets, the bank balance sheets, are off balance. In other words, they have bought more risky, longer-term assets to pick up yield versus the cost of short-term assets. So that's not what a bank is supposed to do. So that is one reason that Fed Chair Powell is worried about bad debt on the balance sheets of banks. And I think that's one of his concerns by putting rates lower. In other words, let's have more debt. And more debt doesn't solve a huge debt bubble that we have when you consider mortgages and student loans and credit card debt and auto loans and corporate debt. The junk bond spread has been widening from treasuries, for example, and that does not make it easy for the big banks to refinance all of these debts that the big companies come up with to buy back shares and to pay dividends. And they're all coming due starting next year. There's going to be rounds of these refinancings for as far as the eye can see. And that's going to be a problem for the banking system and hence for the market.
Now, I'm going to ask you something, because it's short term and long term here, right? Because we know that these debt levels are inflated. Could we actually say it is a bubble? And it sounds crazy. I know everyone's like, Frank, what are you talking about? I mean, it's over $21 trillion in the Fed's balance sheet. But this is a problem that even my late dad was writing about, 25, 30 years ago. I've seen stories. I've actually seen videos from people being on TV talking about in the 70s and 80s, going back doing the research. Same thing. It's almost like you could take them and put them in, took them out and just, threw them on YouTube today. They'd be saying the same thing, where debt is such an issue. I guess the question is when, because we've heard this risk for such a long time, but it seems like, yes, we know it's growing. Yes, we know it's going to be a problem. But is this something that may not hit for 10, 20 years from now? Because we've been talking about this for the last 3 decades, and it hasn't really been a considerable problem until 2008, until, everything was completely leveraged and nobody knew what the hell was going on, and synthetic loans. But I guess what I'm asking is the time frame. I hear about this being a risk for such a long time, but what's the time frame where, wow, this is really going to be damaging for growth?
Well, I mean, as long as the Fed is on the side of the market, which is what the perception is, it could go on for a while. And I was always of the opinion that our debt is a meaningless thing, because we are the underwriter of the world, the U.S. economy, and our central bank. Whatever we do, the world follows. So if anybody's going to have debt, it's going to be the United States of America. And right now, with rates so darn low, I would issue as much 30-year, 40-year debt as I could possibly establish on my balance sheet as the Federal Reserve, because money's still cheap, and you got to take advantage of raising money when it's easy to do. And if you look at the balance sheets of head of households on Main Street, USA, they're getting squeezed again as these rates come down. And, they have more than $7 trillion worth of FDIC-insured deposits within all of the individual accounts out there. That's how much there is. People's savings and people's checking accounts and small businesses who use the banks, there's more than $7 trillion of FDIC-insured deposits. And that's something that we need to raise the interest rate on those so that savers can can feel comfortable spending money.
Now, you talk about the short term when it comes to levels, and let's get to this because, guys, if you don't know, and I mentioned it a little bit earlier, but we're going to go into more detail now, is, we hire Rich to write for us. Rich, we know each other for a very, very long time, and you've written 2 stories on our site, one about Amazon, the other about Apple. The feedback that we got when we requested it, say, hey, what do you guys think of this? And it's called Chart of the Week. It's more trading, but the way you explained everything, where you go through your technical breakdown, it's not just, hey, here's a chart, here's the levels, but you're actually explaining like those levels, your methodology, like you went into a little bit earlier. The feedback has been overwhelmingly positive. So I guess I'm going to ask you, when it comes to short-term, long-term. Long-term, I know you look at debt levels, you look at everything that's going on with the risks in the marketplace, whether the Fed's all over the place. We're looking at slower growth in the U.S. and especially abroad. There's a lot tariffs and Brexit and the uncertainty. Talk about how you look at the short term compared to the long term, because it seems like long term, you are bearish, but short term, you've come here and given us some amazing trades on the long side.
Well, you look when you're looking at short term, you're looking at the daily chart, and the daily chart that I produce on the reports that I will do for Curzio Research will be based on a simple concept, and it has a 50-day simple moving average and a 200-day simple moving average, and these are kind of industry standards for what people look like. Obviously, if a stock or a market is moving higher, and that's supported by rising 50-day and 200-day simple moving averages, you're a buyer on weakness for short-term trades. So, and then there's 2 definitions we haven't come across yet, and that is a golden cross. A golden cross is positive. That's when the 50-day moves above the 200-day, and it signals that higher prices lie ahead. So when you get that signal for a stock, you're going long the stock, a core position, and you're tracking it up. And every time it dips to the 200-day simple moving average, you're buying. Every time it hits a risky level from my analytics, whether it be monthly, quarterly, semi-annual, annual, you're taking money off the table. So you're trading the trend plus adjusting positions based upon short-term volatility. And a death cross is the opposite. That's when a stock is coming down and the 50-day simple moving average falls below the 200-day simple moving average. Then odds are the stock is going to go lower. And that's been a characteristic of so many of these retail stocks that have absolutely gotten crushed in their latest rounds of earnings, that there's so many of them that have that pattern. So it's a matter of looking at the pattern and learning some very simple rules. It's not complicated whatsoever. And I'm a guy that wants to buy on weakness to a value level and sell on strength to a risky level. I'm not a guy that looks to buy high to sell higher, which is called momentum trading. A lot of people can do that successfully, but that's not what the average individual investor should be thinking.
Rich, a lot that you're saying, people who study charts are probably like, okay, this is simple, we get it. And people who aren't are probably like, wow, this is really cool. Let's go see how you use this for individual stocks and starting with, today, right? We're doing this interview. So when you say, you just explained death cross, golden cross, I'm sure you have in your system a lot of these things alert you right away if this is happening. What are some of the stocks that you're looking at today? Because we have seen a rebound, which you called and you actually wrote about on our site, with a lot of these stocks bouncing back, especially Amazon and Apple. But what are you seeing today? And do you have any individual names to share that you might say, hey, you know what, these broke key levels and now it's time to buy, now it's time to sell? Because in this market, it's so important. And I'm glad you're explaining thoroughly, because it's a different market today, guys. I mean, it's all about algorithms. Tariff news comes out on China and Mexico. We see stocks sell off. There's so many stocks that sold off 20% plus in a couple of weeks on something that, we're not sure is going to happen. And when you're looking at technical level, it's such a big part of the market these days, right, Rich? So what are you seeing in the market? Maybe some ideas you could share, because this is something that I think everyone needs to incorporate in their research going forward, because that's the market we're in today, and that's the market we're going to be in the future.
Well, the stock of my focus stock today is Broadcom, symbol AVGO. Last evening after the close, they announced that they are providing components to Apple products, including smartphones and watches and the smaller devices. So they have a 2-year deal now to do that for Apple. So the stock traded significantly higher in the overnight trade, and I have what I call a quarterly risky level for the stock at 295.09, which was almost tested in after hours trading. And then the open came this morning, and the stock gapped higher as was expected, but it didn't hold its gains. The stock came down to a monthly value level at 282.42. Now that's a pretty huge range, isn't it? And so the first buy that you would have is at 282.42. If the stock after the stock's going to report earnings after the close on Thursday, and if it's a negative reaction to earnings because the Apple news isn't news for the last quarter, it's news moving forward. So you're going to look to add to the position if it comes down to its annual value level, which is 260.78. That's a lot of volatility, but, name a stock that went down more than 22% from its May high to its May low. Broadcom. So it was the biggest loser on the trade tariff situation. So you pretty well know that part of it is built in. And so you're looking for factors other than the charts to whether you want to own the stock or not. And then you look at the fundamental screen, and I use what's called macro trends, which I go in and I click on it on the ticker, and it gives me a PE ratio of 14.75. That's not bad for a momentum stock. And not only that, it pays a dividend of 3.86%. So you can buy this stock not only for the momentum, but you can buy it for the dividend. And that's the theme for the stock of the day.
And talk about dividends, because now and you monitor all sectors, and you're quick to point out where, if you see consumer staples rising, utilities rising, those are defensive sectors, not a good sign for the overall market. And, we'll get to gold in a minute, because I know you've talked about gold, but, what are you seeing in terms of sector analysis? Because, these technology companies are starting to fly higher again. But, are you looking at things from a conservative standpoint where, hey, let's get into defensive areas, or it's, there's still a lot more room on the upside because these things are just coming back off of being down tremendously over the past 4 weeks?
Well, when you look at I look at the 11 sector ETFs that represent the 11 sectors of the S&P 500, and at Friday's highs, that's June 7th, REITs, staples, and utilities each set new all-time highs. And they're obviously the most conservative of those three sectors are the most conservative. And those are the ones this week are performing the worst. Then because we've switched over quickly from safety to momentum. And even the yield on the 10-year, which I didn't expect would go back to touch 2%. I think the low was like maybe 206.
I don't think anyone expected that. That was a pretty big surprise, yeah.
Yeah, well, I mean, the TLT was the one that broke out, and that's the 20. That's an ETF TLT for the Treasury bonds 20 plus maturity original 20-plus maturities are in that TLT. And that set its high on June the 3rd. And junk bonds, that peaked on April 30th and has been going essentially sideways to down. And year to date, the Treasury is up 8.4% and junk is up 6.8%. In the beginning of the year, the junk bond was way outperforming Treasuries. And I kept saying you don't want to own junk bonds because it's too related to stocks. You're better off in Treasuries. So Treasuries and utilities, but I didn't like utilities because the yield has gone below 3%. I mean, it was the XLU, which is the ETF utilities, the dividend yield went to like 3.78%, 2.78%, pardon me. So I said, you're better off buying the dogs of the Dow. Now, you talk about the dogs of the Dow, you have the two oil majors, Chevron and ExxonMobil. You got Verizon, you got Pfizer, you got Coca-Cola, J.P. Morgan, and IBM. And at the lows of May 31st, that basket of stocks was up 5.5%. At this past Friday's close, that same basket of stocks is up 11%. So the percentage gain from looking for dividends did quite well in an environment where the volatility has returned to the upside for these momentum names. But it's also a time when investors are interested in dividends that can be solidly above 3%. And as we discussed earlier, Broadcom is 3.86. It's not a Dow component, but if you looked at the Dow stocks this morning, IBM is 4.85%, ExxonMobil 4.71%, Verizon 4.36%, Chevron just above 4%. So they're the ones you want to focus on in terms of Dow components.
Yeah, it's so much great stuff there, Rich, just with the dividends and how you're seeing almost money go into it. We know the Fed's going to lower rates. People are going to seek yield, and they're seeking yield, not just in dividend stocks, but also, cheap dividend stocks that have growth potential, that are kind of momentum names. And you're seeing that, right? It's hard to get something that's cheap.
Well, I mean, you're looking at both momentum and value at the same time. And it's hard to have times when that is occurring. And it is occurring now, which is one reason you may be at your maximum allocation to minimum allocation to overall to stocks because of the longer term bear market thing. But when you're booking profits on stocks you've owned for 10 years, you still have more money invested in those stocks, even if you take half of it off the table.
Yeah, I hear you. So, no, that's great stuff. And I want to get to one last topic here before I let you go, because I get so many questions on it. Gold, we're seeing, gold prices rise, and, took a little bit of a step back last 2 weeks as the market, did a lot better. But you're seeing gold make, higher lows going out through 2012. It looks very attractive even from a macro standpoint. Yes, we're lowering rates, but, the Fed's doing everything they can to spark inflation. Our debt levels. I'm not too sure if gold is used as a safe haven anymore. I think treasuries are much more of a safe haven. But what are your thoughts on gold? So many people out there. I mean, it's been such a long time. It's a cyclical market that's been cyclically depressed for, since 2012. What are your thoughts now? Is it time to start jumping in and, be specific, whether it's, the commodity, which is fine, which gold prices have not really done that bad since 2012. But if you're looking at gold stocks, especially junior miners, they're still down tremendously.
I like Newmont Gold Corp, symbol NEM. It's the biggest one now, and it tracks COMEX gold futures very well. So You can own a stock and not be involved in trading futures. And the reason why I look at things that way is the average investor does not qualify to trade financial futures. And in my writings, I realize, and especially since I was chief market strategist for many brokerage firms, both large and small, people have to be approved to trade options. People have to be approved to trade on margin. People have to be approved to do a lot of different things. And I can't write a story unless and talk about a stock unless I'm very conservative in the way I think, because I can't assume that someone's allowed to buy a stock trading under 10 on margin. You follow what I'm saying?
Absolutely.
And so I'm careful not to get too aggressive in my wording, but essentially try and guide people through the difficult times in the market and when to be conservatively be aggressive long. And I would never recommend shorting because most investors are not allowed to short because of what the restraints put on them by the firm they have their trading accounts in or their investment accounts in. There are ways to be defensive, and that's called cash. It's called treasury. It's called yield.
No, it definitely makes sense, Rich. So listen, we covered a lot today, and one of the things I wanted to highlight is that, guys, Rich is writing for us. We're getting amazing feedback. It's not just, listen, if you're not into technicals, please take a look at this, because for me, I've always explained to you, doing this podcast for over 10 years, you want to always learn different strategies. I mean, I benefit from having guys like Rich on, interviewing some of the best minds out there for 10 years. For me, it's always learning about them, even if you don't agree or disagree. But the way the market is now at algorithms, you're seeing stocks flip on news that can go down 20-25%, and learning these key levels and you explain it to them, it really is a great addition, Rich, and we really are happy to have you on board, bud.
Okay. Thanks a lot, Frank. I'm sure I'm going to enjoy it.
It'll be really cool. And your next story comes out Friday. And Rich, thanks so much for joining us, bud. I'll talk to you soon.
Take care, Frank. Bye-bye.
Hey, guys, great stuff from Rich. So I'm thinking about having him write a trading newsletter for us. So let me know if that's something that, especially your subscribers, services, if you're interested in, you can let me know, frank@curzioresearch.com. But be sure to check out his two pieces first before you comment, because I was very surprised at how much positive feedback we got. And I really meant that towards the end of that video, when this is the market that we're in. You need to understand technicals. You need to understand levels. It's very important in a market where you're seeing and just tariffs being announced and retailers getting smoked 15-20% after reporting good earnings. Just whipsawing out of certain stocks. I mean, you're seeing them where, the company might report bad earnings. It'll be down 5, maybe should be down 7%. They'll lose 20% of its value, which is crazy. And then you'll see it like a week later come, roaring back. But anyway, levels are extremely important here, like you said, and you highlights all levels, what you're holding, what you're not holding for short-term trades. But it's very important to learn about technicals, because not that you become traders, and most of you listen to this, so I'm sure you're not traders. You have your own jobs and stuff, and to be a professional trader. Guys, I've met, there's probably 10,000 people out there that call themselves professional traders. I know about 3 of them that make money being a professional trader. Maybe 3 or 4, and Rich is one of them. Buddy Jeff Clark is another one, who's an amazing trader, who I used to work at Stansberry, who I think is amazing. But it's you have to sit in front of your computer all day. You have to be disciplined. It's very, very difficult. But in this market, it's important to understand those levels, know those levels. It can help you when it goes into entering a new position or getting out of position once it breaks key levels, because it's probably going to go lower. So a lot of good feedback, and I definitely want to hear from you. And just, really quick, what I took away from that interview, and I kind of was all over the place at the end because I was just fascinated where, when he's talking about Broadcom offering value, yield, and momentum, and we look at the Fed, what's the Fed doing? Well, the Fed is lowering rates right now. So when they lower rates, people are craving yield. And when people are craving yield, they're going to want high-yielding stocks. Now, where are you going to find those? Consumer staples, utilities, which have come down, which is interesting. So that could be a buying opportunity. Start looking at utilities, start looking at consumer staples that pay good dividends, that are growing. Never just look at it. Don't ever buy a stock that pays a high dividend without having any catalysts, because it doesn't matter if it pays a 6-7% yield, which usually means that something wrong if they're paying that high, if they're not, an MLP or whatever. But before you go out and buy and get that high yield, you want to make sure that the company is growing. It has catalyst, because that 7% yield is going to mean nothing if the stock goes down 20-25%. I think people make a huge mistake when it comes to dividend stocks. But for me, that's something I'm looking at right now. The Fed's lowering rates. We know it's going to be a push into high yielding securities, and with utilities down and selling off a little bit, and so are consumer staples, you may find 1, 2, 3, 4 names in that sector that look attractive here. So that's why I was asking you so many questions, to find out the right ideas. And as always, Rich always shares his favorite ideas. So guys, let me know what you thought about that interview. Again, I always say this podcast is about you, not about me. Let me know at frankcurzioresearch.com. If anyone who's read his stories, feedback, let me know what you think, because I would love to have Rich write a newsletter, a trading newsletter for us, which I think he's interested in. But again, we want to make sure we're doing the best thing for our customers, and that you guys really want something like that. And keep in mind, Rich is just one guy out of the hundreds that I interviewed over the past 10 years. If not 1,000 people I've interviewed. Because I used to do a daily podcast at the street 8, 9, 10 years ago, whenever. Used to have guests on all the time, every single day, doing an hour podcast. Pretty crazy, very busy. But I happen to have a great network because of you. A lot of these people are willing to write for us. I want to put great people in front of you with great ideas that are also going to educate you. So if you see somebody else that I'm interviewing that you say, hey, Frank, you know what? I'd like to learn more about this guy. I'd love to see if he writes a couple pieces for you. Let me know. There's a good shot we can get him, create a deal, and make sure we have the best content on our website. But again, I'm only going to know that if you email me at frank@curzioresearch.com. Now, let's move on to my educational segment. And when I look at a company like Apple, and I'm taking Apple for a specific reason, to prove my point, to show you of how you could buy some of the best brand names at big discounts. When you look at Apple, it's the first company ever to hit $1 trillion market cap. That was last year and came off of that. Now we know Microsoft, I think, is the only company with $1 trillion market cap right now. But it's kind of incredible when you see Apple saying, wow, it's $1 trillion company, considering the tech giant was about 3 months away from going bankrupt. People don't know that. What they do know is Apple is often referred to as the king of technology, one of the most innovative companies ever. Maybe not lately, but come on, the iPhone, the iPad, the watch, used by hundreds of millions of people every day. That's why I consider one of the most innovative companies on the planet. But Apple's rise to this level was not easy. It wasn't like a straight line, everything was great. Because if you look from 1985 through 1995. And by the way, that's the period where Steve Jobs says he got fired, but he left the company. Apple was in turmoil. The stock price was in free fall. They had very little innovation, which in turn helped customers take huge market share. And the following year, 1996, things really got ugly. Apple was burning through tons of cash. They lost $860 million that year. $860 million. Talk about a company, I think the market cap was around $3 billion at the time. Again, it's $900 billion today. But there was no end in sight. And the company had little catalysts, like no exciting products in the pipeline. So stock hit its 12-year low for more than 6% of the year. And then the chief financial officer at the time, Fred Anderson, initiated a big bond offering of over $600 million. And he said, well, that was to keep the company afloat. It wasn't enough. So as the year progressed, Apple's losses kept mounting. So with just a few months of cash left in the bank, the company made a desperate move. In January 1997, Apple decided to partner with its long-term rival, Microsoft. And it's funny. I kind of remember that. Because Steve Jobs was talking at the Mac Expo conference. That's their annual conference. And it may have been the only time that Jobs got booed in his life. I mean, booed by the entire audience of Apple diehards. And they booed him because they hate Microsoft. And you can see why they're pissed off. Microsoft's eaten Apple's lunch for years. It signed numerous deals to put, Windows and Office in every personal computer. Plus, Apple and Microsoft were suing each other for patent infringements. Tensions were really high, but Apple had no choice. They had to do something. And they signed a deal and they said, hey, Microsoft, you know what? We'll support Internet Explorer in your browser for 5 years. And in return, Microsoft invested $150 million, not billion, but $1 million into Apple. And also created a new Office product just for Mac computers. So when you look back at that deal in 1997, and that's just before a few months later, I think Steve Jobs became the CEO of the company again, and the rest is history. But that deal was really good for both companies when Microsoft was able to keep a smaller competitor from going bankrupt, which is a very big deal back then. I mean, it's going to result in fewer headaches. The government was all over them, attacked them all the time about Microsoft being a monopoly. So this is a good thing for them. And Apple was able to get a much needed cash injection. And it only took a year later, because they used that cash to redesign the Mac computer, which was a big hit. Sold over 800,000 units in the first 5 months. A few years later, Apple released the iPod, turning the music industry upside down. And a few years after that, we know they released, one of the best phones, which is the iPhone. And now the company's the biggest in the world. So you're looking at Apple today generating $250 billion in sales. And I know I talk about the stock a lot, but not the company's amazing. Just sometimes I feel it's overvalued. You're looking at a company generated $44 billion in free cash flow, sitting on over $200 billion in cash on its balance sheet. $200 billion. Remember, that it got bailed out by Microsoft for $150 million. But to put the $200 billion in cash on its balance sheet, if you want to put that in perspective, guys, because I don't think people understand, and maybe you do, but there's only 25 companies in the entire S&P 500 with market caps, not cash on that balance sheet, but market caps greater than $200 billion. That's how much cash Apple has. That's how great they are. Now, it's important for you to understand this because I chose Apple because it's the biggest and the best, but it highlights how even the biggest and best companies can go through rough periods sometimes. This isn't just Apple. This is every single company, basically. You can go through the S&P 500. I mean, Microsoft had its share of problems from, they call it the lost decade. It was really 13 years. The stock price didn't go anywhere from 2000 to 2013. It was just Windows, Office, very little innovation. That was under Ballmer. Then Nadella took over, got into cloud, and the rest is history, the biggest company in the world. Walmart had its share of problems in 2015. I mean, the stock fell 40%. Yeah, dollar stores really, and even Target take a huge market share. Say we have Walmart near an all-time high. Look at comic book giant Marvel. I mean, they came close to going under in the 1990s. It was struggling to create new revenue streams for its content. This is before they decided to come out with all these movies. Today, I mean, look at the company. Disney bought them for $4.5 billion in 2009. And man, I think they might have generated that in the last 2 movies with Avengers. But they produced some of the biggest revenue-generating movies in the world. But Marvel was close to bankruptcy. This was around 1993, I believe. So if you look back, almost every company in the S&P 500 had its shares of ups and downs. And you're looking at the Apples, Marvel, Starbucks almost went under in 2008. I mean, IBM, AIG, General Motors, Best Buy. A lot of these companies came close to bankruptcy. And when that happens, what happens to the stock price? It gets destroyed. So you want to try to pick up a brand name at the cheapest price possible. And when you see crazy low prices, it usually means something's very wrong with the company. Something's going wrong. But remember, when you're looking at these big brand name companies, many of them are able to right the ship. It could take IBM. It took a long time. And 22 straight quarters of revenue declines. I get it. But we recommended it. We're up in the stocks, #1 performer in the Dow. Could be one of the biggest players in cloud, in hybrid cloud, private, public, and private cloud, after the Red Hat acquisition, which is closing, I think, towards the end of this year. Maybe sooner. And sometimes it happens really quick, maybe a year or 2. But all these companies go through these huge problems. And you say, well, Frank, how do I buy these stocks? Because when they're coming down, I don't want to try to catch a falling knife. And there's ways to do that. One thing that I love to see is insider buying. And insider buying from the CEO, from the CFO. I want to see that insider buying, because if the insiders aren't buying with that stock down 60%, why the hell should you be buying? That's not the end all. It's not, insiders are buying, let me buy the stock. No, I've seen insiders wrong a ton, even though the only reason why insiders buy a stock is because they think it's going higher. Hundreds of reasons why they'll sell stock, diversify, whatever, pay taxes. But when you buy it, there's only one reason. And they're not looking for short-term gains of 20, 30%. Trust me. So insider buying, when I see a stock that's down a lot, makes me look into the company more. And when I see a brand name company down tremendously, you want to see what pushed it down. Is it weakness in certain categories within their brand? Say if it was Marvel, is it, Avengers is their biggest, asset? Are they seeing a decline in sales and nobody wants that? Nobody wants to see it anymore? Of course, that's not the case. I'm just saying. But you're looking at Cabbage Patch Kid dolls or whatever. I mean, sometimes things are amazing and they just flying off the shelves, and the fad runs its course and nobody wants it anymore. So are you creating other brands, or are you able to turn around that brand? You look at Burger King and sales surging after they just came out with a new Whopper deal, like a certain type of Whopper, and that worked, and they're turning it around. And what happens? You look at the stock price, you're going to see sales go higher, but you want to see if that marketing plan's working. Is it more macro conditions like we see with gold or uranium, where the conditions are just horrible, but you're seeing stocks trading at ridiculously low levels? Our insiders buying, but the macro level is hard to predict. Nobody knows what's going to happen in the future. For me, I like looking at the details, looking at the last quarter, listening to management, seeing what's going on, because if you have 3 or 4 reasons why the stock is down so much, and those reasons change, and then you're seeing insiders buying, guys, you just need that stock to go from bad to less bad, and you're going to see 30, 40, 50% gains on that name. I've seen it happen numerous times. I've done that strategy with small caps a lot. We just find, and even biotechs, where they get completely beat up, and you have to look at the news why they got beat up. Maybe the FDA just wants a little bit more, information on safety. And you'll see a stock lose 50, 60% of its value, and yet they're going to come back to the market, to the FDA, knowing exactly what they want, and they're going to come back to the market 6 months later, maybe 9 months later, give you an opportunity to buy the asset at a 60% discount. But when you look at the biggest brands, every single business has problems. A lot of these businesses almost went bankrupt over their, decades and decades long of being, market leaders. But that happens. But you want to look at some of these names that have gotten crushed, because anyone that bought Apple in 1988, 1999, even after the tech crash, I mean, come on, you probably own your own island. Imagine buying Microsoft in 2013 before Nadella got there. Imagine buying Marvel when they were having problems, before they really got into movies and things. And the reason why I'm mentioning this, because there's a great brand name company just recommended in Curzio Research Advisory that everyone's familiar with. It's down tremendously, but all the reasons that pushed that stock down no longer exist. And it showed up in last quarter's results and even the quarter before. And the stock's still trading near a 20-year low. And more important, insiders are buying hand over fist, which tells me we're pretty close to the bottom. And the fact that they showed huge gains in the brands that they were doing so bad in show me that their turnaround is working. Their cost cutting is working. And when companies cut costs, that money goes directly to the bottom line. So not only have you able to turn around operations, your company's much more lean now. You're getting those benefits of sometimes hundreds of millions of dollars in cost savings, shutting down plants, reducing headcounts. And then if you're able to turn around operations, now you're looking at the stock that can go up tremendously off its lows. That's one of the names that I just found. It's a brand name that when you see it, you're going to be like, holy cow, Frank, are you serious? Trust me, read the report and you're going to know why I'm recommending it. A lot of you guys are CRA subscribers. If you're not, I always provide a special deal for that. It's $49 for the entire year. You can go to CurzioResearchOffer.com. That's CurzioResearchOffer.com. Can at least you see my research close up, our 10, 12-page reports, everything I've wrote since inception. And, if you're interested in that, that's a special deal that we have specifically on that website that you can go to at CurzioResearchOffer.com. If not, no worries. As Rich highlighted so many ideas, I'm also highlighting ideas, and I break down individual stocks, and you get ideas through the podcast for free. But really to see our performance and track everything and see the research and really get that educational component of how I'm coming up with these ideas. I mean, $49 for the entire year, guys, not the month. That's a level where it's kind of like a break-even price for us. So, and I do that for you because over my 25-year career, and I mentioned this earlier, when I've done the right thing by people, it comes back 10 times more. So providing a nice newsletter like this builds my network, it results in even more ideas, and that price is set for you guys, which is incredibly cheap for the research that you're going to get for that newsletter for the entire year. So guys, thanks so much for listening. Always appreciate support. Be sure to email me. Let me know who you want to see write for us, who you want to see me interview. Let me know what you thought about Rich's interview, also his content. If you'd like to see him have more of a role here, maybe we can launch a newsletter around Rich Suttmeier. Let me know. FrankCurzioResearch.com. This is about you, not about me. So we want to serve our customers and give you guys exactly what you want. And I want to put some really great people in front of you. So really appreciate all the support. And I'll see you guys in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.